The market is pricing that inflation is going to fall and fall fairly rapidly from here. The market is pricing that the Fed is going to cut next year. Do you believe either of those two things?
I believe the first, that the highest probability is that inflation it's already starting to fall, and I think there's a lot of evidence that it's going to continue to fall. The things to watch, in my view, are service sector wages and employment, and ex-food and energy, CPI. The second question, I think, is a lower probability. My guess is they get to whatever their destination is, somewhere between 4.75 and 5.25, and if inflation is more persistent, higher than that, and that they sit there for a while because of the point that I made before, that I do believe that their tolerance for risk is asymmetric.
Ralph, the S&P's up 10%, circa 10%, a little bit below since the last Fed meeting. Fed's not going to be happy with this. Is the market fighting the Fed?
I think we're in a period of time where I would say the uncertainty about the economy is the greatest that it's been that I can remember. And that's not to say that it's horribly bad. I mean, this is not going to be like 2008. It's not going to be like COVID. But do we go into a recession? Do we go into a mild recession? Or do we go into a little bit more severe recession? Nobody knows the answer to that. And as a consequence, if you look back historically, markets have tended to bottom after the onset of recession. Mm-hmm. So there's a risk that if we do go into a recession, that the markets are a little ahead of the economy.
Yeah, especially when this has been a really telegraphed recession. So that's obviously unique as well. Do you feel that in the investment banking world that the world has adjusted to higher rates and that the more money's open, everything's kind of opening up a little bit, or is there still ways to go there?
There's still a ways to go there, particularly in the debt markets. There's a congestion in the banking system. Banks generally like to lend and then sell a good portion of the debt that they've taken on. Twitter, $13 billion, still sits on the balance sheets of the banks. There's several other transactions which have not moved. So you have a fair amount of constipation in the banking system right now, and that's exacerbated by the fact that deposits are leaving the banking system and going into T-bills or two-year treasuries or money funds.
Because you can make something from them
because you can earn more money. When rates were zero, deposits were flooding into the banks.
So where does the pain then go from there? Like, private credit guys seem to be chomping at the bit. But does the pain spread there, or is there opportunity?
Well, credit losses in the private credit system are not nearly as systemically important. They're painful for the investors, but leverage in the private credit system is maybe 1 to 1, maybe 1.5 to 1. In banks, it's 10 to 15 to 1. So if you have a 10% loss, that can wipe out capital in a bank. In private credit, some pension fund or sovereign wealth fund, instead of getting 100 cents on the dollar, is getting 90 or 80.